Welcome to episode 12. We just keep going. Can't believe we just launched our double digits. I'm here with Alex.Nisenker from Greybrook Realty Partners. Yep. And I'm really excited to have you on because I feel like I talk a lot about buying real estate for yourself. I talk about buying real estate as an investment. But there are so many other ways to invest in real estate without actually owning it outright or saying that address is mine or being a landlord. And I also feel like, and including myself, I don't think I really kind of understood how you guys all worked before I was introduced to you guys also. So I'm excited to talk about it. So welcome.
Yeah, thank you very much for having me. I think you're absolutely right. I think along the spectrum of real estate ownership, you can kind of fall anywhere along the spectrum with, what I call, I try to term like the people that actually roll up their sleeves and own real estate and become landlords. I kind of term them the fearless investor because you really got to have courage to go into that. That's real work, and there's so many pitfalls that could happen and everything else.
Oh my gosh,
that's like
tenants.
Tenants
sure.
and our wonderful legislation here. So yeah, that's one end of the spectrum, and the other end of the spectrum is like the super, super passive way, which is just like public REITs.
Right.
And just exploring those markets.
And very passive for sure. I feel like you're kind of like right in the
middle,
right? Which I think is really exciting. So as we were kind of talking off camera, I have clients will say to me, like, should we buy an investment property? What does that look like? What kind of investment property should it be? Should it be a condo, pre-con? And my first question is, let's start from the very basics. Do you want to be a landlord?
Yeah.
And if you don't want to be a landlord, please do not buy any investment property because you are going to be so miserable,
Totally.
And by the way, there are wonderful tenants. I shouldn't say that I represent tenants. There are fabulous tenants. It can be a marriage made in heaven.
Totally.
But you have to be ready to deal with people, broken fridges, calls in the middle of the night, heating not working, all of that good stuff. So anyway, all of that to be said, I thought we could kind of just like break it down. So who is Greybrook?
Sure.
And what do you guys do? And what do you do?
Sure, yeah. So Greybrook is a private equity firm. We focus exclusively on real estate as an asset class. So within private equity, firms can dabble in multiple asset classes, and they can even dabble in their approach into what positions they take within companies or the investments they make. So Greybrook is entirely real estate focused,
okay.
and we take an equity position. So we're not debt.
Right.
We are actual owners and partners within the developments that we choose to work in.
Okay.
So think of us as both financiers and as sort of intel and resources that we offer to our development partners when we partner with them. And partner is a true word because we are equity. We have skin in the game.
Right.
When we partner with these developer partners, that we're adding value beyond just writing the checkbook. So when we go into a project, our investors, our respective investor base follows along with us. So they are providing capital in order to fund an equity position, an ownership position in a given project.
So for everybody who may not even know, I almost want to go backwards and say, can you explain what even like a private equity firm is? I think that would be a great place to start.
Yeah, so let's compare it to like the public markets, right? So today you decide that you are a big fan of Apple and you're going to go to your respective stock account and you're going to buy shares of Apple.
Great.
Now you are technically an owner of Apple as a company, albeit one gazillionth fraction. And you are sort of watching the public markets, and as Apple shares go up, you're happy, and as Apple shares go down, you're not happy. Okay. And you can choose to enter or exit.
No one's happy right now. No one's happy.
Well, sure. But you could choose to enter or exit your position anytime you want, right? So now you have the private markets. So the private markets are kind of an by invitation marketplace. Okay. So they're not. Exactly.
Differentiating it. Yeah.
It's not available to everybody. You can't just sort of go on a database per se and explore what opportunities are out there and what can I put my money in. So it's a by invitation kind of way of placing capital. But we're essentially doing a similar thing to what you just did with buying your Apple share. So you see Greybrook is speaking to you and says, hey, Rachel, we're about to go develop 1,500 doors in Hamilton. Here is the parcel of land that we're going to be acquiring. Here is the amount of doors. Here's what we plan to sell every door at. Here's why we think this is a great deal. Here's our underwriting logic. Here's our sort of investment thesis, all of that stuff.
Right.
And this is the amount of equity or the capital cash that's required to get this thing off the ground. Obviously, banks will eventually be layered in, and different lenders will come in to sort of see this thing through the middle. But from the very, very beginning, this amount of hard cash that's required to get this thing in motion.
Okay.
So now you, in the same way you sort of reviewed, the Apple's position in their balance sheet and P&L, and if you did or you didn't, it doesn't really matter. But now you're sort of saying, okay, this is interesting. I think I believe in this. I think I understand what Greybrook's going to do here, along with their developer partner. I'm really bullish on Hamilton for whatever reason. Right. I like it. I think at the end of this project, there will be great profit to be made, and I want to participate. I want to now become an ownership of, in this case, for example, it's, hundreds of acres of land.
Right.
Which will eventually be converted into low-rise housing.
Okay.
And you say, okay, I want to participate, in which case you will buy a share. Okay, so you'll buy, in our case, it's called a limited partnership unit, a LP unit.
Right.
You become a shareholder in the overall project.
Right.
So instead of owning an individual door or, like in traditional pre-con, you now have a fractional share of this whole behemoth.
Right.
And as the project comes to fruition and as the project converts into sales, depending on how those sales happen, whether they happen over and above what we originally underwrote we're going to sell for, or they can happen below what we originally underwrote we're going to sell for, you are you're participating in that ride with us. So you are now an equity owner, a private equity owner of any given project. And with our firm, I kind of use the other analogy, we're an a la carte firm, meaning that when you work with Greybrook, you're not investing into a generic fund, or you're not investing into an overall
not a black
thesis.
Box
Exactly.
Right.
You review every project on its own merit, and then you decide which projects you like and which projects you're a pass on. And we as a firm will also guide you on ensuring that you're not overexposed to any one geography or any one style of housing. So, we're very much advisors to our investors to say, hey, you've got a lot of exposure in this market. Let's sort of pass on this one and wait for the next one.
Do you work with specific, I feel like I know the answer to this, but do you work with specific builders? Like, do they come to you every time? So for example, I won't name them, but there was one that I am very familiar with. They come to you and they're like, okay, we're going to build, this project in the Junction, and this is, and they come to you versus the other way around. What's the relationship?
Both. It goes in both directions.
Okay.
But yes, we're I would say highly selective on the builder partners we work with.
Oh my God, especially these days.
We have to be. Yeah. Generally speaking, the scale of projects that we take on are fairly large, so it requires a fairly sort of broad organization to be able to execute on those projects with us. In addition, different developer partners have sort of subject matter expertise in different areas, whether it be geography or construction style or whatever it is we're doing. Right. So, if we identify a project, we'll try to do our best to match a developer partner to that project that we think is best suited to execute. But more so, it's our developer partners coming to us and saying, hey, we want to do this. We'd love for you guys to be a partner with us. And again, it goes beyond the check. To be honest, none of our developer partners are stretched for cash. None of them really need capital.
No, you work with very large names that most people would know. Yeah. So you can go on the website and see. These are not unknown, and those are the ones you do not want to. I mean, I've had clients who are like, oh, I saw this really great building, and I look it up, and I'm like, I've never heard of them. Don't touch a 10-foot pole.
Totally, yeah. And listen, the GTA is a massive landscape, and there's all kinds of names popping up every day.
Yeah, it's scary.
So
scary stuff.
We are selective, and a lot of that is just on precedent of relationship. We've already got great relationships with some fantastic builder developers in the province, and we work south of the border as well. So we have some great partners there. But generally speaking, it's a very, very collaborative approach, right from underwriting, right from identifying the project, understanding if it's something we want to do, through construction and all the way to marketing and sales and execution.
What the return will be.
We're hand in hand the whole way.
So, which is great. It doesn't mean they just come and go, okay, this is the project, this is how much it's going to cost, this is what you want to sell it for. You go out and hit the streets and dial for dollars. That's not the way it is. Sure. It's a collaborative, okay, this is what we want to build, and you're like, this is going to make money or it's not going to make money. Exactly. for the investors.
Exactly.
So going back to the Apple stock, so I go and buy Apple stock and I'm like, you know what? Either it's at a high and I'm going to sell it, or you know what? My life has changed. And I need to sell it because I need the cash. It's different in your case. So what is, just kind of walk us through what those timelines are.
Sure.
So I come to you, I'm like, okay, Alex, sign me up. I've got X amount of dollars. Perhaps what are the minimums? And what are the timelines?
Yeah. So we, generally speaking, on an annual basis, we'll raise for about 8 projects a year, and we will do due diligence on probably close to 100, but we will greenlight about 8 to 10, let's say, as a sweet number. Every project has a different scope and a different horizon or lockup period, which is what you're referring to. And we do that on purpose. That's by design. We don't want every single project to be
closing at the same time.
At the same time, or like every single project to have a 5-year sort of start to finish horizon. So it really depends on the size and scope of the project.
Which is nice, because then people who come to you have a menu. It's not like, would you like orange juice? Or some orange juice.
Yeah, exactly. Right? Freshly squeezed or out of the bottle. It depends. I would say on the low end, on the kind of quick turnaround of capital side, it's probably in the 2.5 to 3 year range.
That's not bad.
That's not bad. It's mainly our value add stuff. So we will do a little bit of value add where we acquire existing real estate, usually sort of outdated apartment buildings.
Oh, okay.
A portfolio usually, and we'll rehab those apartment buildings, improve cap rate, and then sell it off to a pension fund or a REIT or a private buyer.
Oh, interesting. Okay.
And those turn around quicker. It's more predictable. You don't have the typical sort of development stuff on the front end. So that is usually 2.5 to 3 years. And it can go, a bunch of stuff will land in the middle. Our sweet spot is probably 4 to 7. I would say a lot of our stuff.
If you're starting like a brand new project,
yes,
that would be
it's usually
longer.
In that range. Yeah, 4 to 7 is usually the range. And then, for example, we did a raise on one of our projects late last year called the Whitby Marina project. That is 4 high-rise towers right on the Whitby shoreline, right next to the GO station.
Who knew Whitby was cool now?
Yeah, it's cool.
Oh my God, Durham is happening.
It is. So if you could imagine how much time it's going to take to develop, sell, and title register 4 high-rise towers, that's 9.5 years start to finish.
Wow.
So that's a lockup period.
It's beautiful. It's actually surprising it took so long for them to actually build up that waterfront.
Yeah.
Because it is real. I have clients who live out there, and it's gorgeous.
I'm very bullish on that project specifically. It's one of my favorites over the last little while. So technically speaking, usually when you are investing into a Greybrook LP, and every project is its own limited partnership, its own LP, you are waiting for that project to exit to get your distribution. So kind of your principal and all of your anticipated returns come in kind of one shot.
When they sell
everything out, exactly, and exit and title transfer and everything. When the project essentially exits,
when they've actually created the condo corp and
everything, exactly.
And everyone's taken occupancy,
exactly.
And
that when we put out an investment, we have what we call it like kind of an offering document or investor presentation, and all of that is spelled out for you. All the sort of key dates of this is when we're going shovels in the ground, this is when we're anticipated to launch the sales center, this is when we're anticipating we'll be fully done. All that stuff is kind of broken down for you. So you're usually on a typical project. Let's say, it's going to take them 6.5 years. You put down $1 today, your dollar and returns come back in 6.5 years.
Yes. Okay. So minimums.
25,000 is our minimum. It's not a small amount of money by any chance, but it's not egregious. It's not prohibitive to kind of the average everyday investor to participate.
I was just going to say the average investor, not the average person, but yes, the average investor of someone who's and listen, I think it's a matter of same idea. Okay, so here I am. I want to own something. Toronto real estate is so expensive. I have to have 20% down to buy, or even if I'm buying, a pre-con, I've still got to eventually put that 20% down. Yeah. And I only have 50,000. Someone just left me something, who knows, whatever it is. And and then it becomes an option for them.
Totally. And I would even take it one step further. Even, a few of my investor clients sort of take this approach is that when they're comparing, let's say, a private equity placement versus a pre-construction, because a lot of times it's kind of an either or situation for people.
Yeah, it'd be interesting to walk through that when you think about it.
And so when you're going into a pre-construction deal, strictly as an investor, you're kind of saturating all of your investment dollars into one bet, right? So let's call it $150,000 you have to deliver to the builder over X amount of time.
Right.
You really have to believe in that building. You have to believe in that area. You have to believe in you're really, really sort of hyper believing in that. But maybe you're wavering on your belief. You believe it somewhat, but you're not sure. It's a great way to spread chips across the board in the sense that if you really like this geography, but you're not 100% certain, okay, don't commit all 150 here, but maybe place 25, 50 here, and then go place 25, 50 somewhere else. And now you've kind of got, chips on different positions. And now you've sort of hedged your risk a little bit. You're more diversified. And we do that even within private equity as a sub-asset class. It's, if you have $150,000 to commit to Greybrook, I will encourage you, even within Greybrook, not to place all 150,000 into the same project. I'll encourage you to stagger the years of return, stagger the locations.
The stock, same the way you would build a portfolio for sure. I also think it's really interesting, and I would be curious to hear how it's changed for you from a business standpoint or for Greybrook is, years ago, let's go 10 years ago. Mm-hmm. So we were just talking about cost per square foot. So I'll let you deliver. I don't want to be I don't want to deliver the bad news, but average square foot and that means when you buy a condo, if you are buying a pre-con, they're saying, okay, well, if it's 800 square feet condo, this is how much we're charging per square foot. And that's how they assess the price. And that will differentiate across amenities, all that stuff. It doesn't matter location. So average is now for a pre-con build?
Well, so I can tell you the average total sale price on Toronto in general is right between $1,350 and $1,400 a foot right now.
Crazy.
Yeah.
Crazy. So we were talking about this before, again, like looking at where you're investing. So it used to be that pre-con, everybody bought into pre-con because you could buy it at $600 a square foot, right? It was really, really cheap. Sure. And
relatively.
Relatively fine. And you didn't have to put all the money up front and, you could rent it out and all that good stuff. But a lot of the time you didn't have to rent it out because between the time that you put your money in and the time that it was finished, you watched your profit increase and you flipped it on assignments. Sure. And it was great. Sure. There were tons of people who made a ton of money. Yeah. Those days are done. You're not doing that anymore. Yeah. There's no way. I mean, unless you were somehow like friends and family and you got some crazy deal and you knew someone, it's just not happening anymore. So to me, what would be interesting is, has that affected your business in the sense where you can't put that kind of money into that anymore and flip it and make that kind of profit? And are you seeing those people move over to you?
I mean, I can only speak for kind of my own book of investors. It doesn't really impact me because, again, the huge attraction of doing a private equity deal or investment is the truly passive nature of it. So even on the assignment side, right? There's work to be done. Even if you're not going to you're going to take a tenant, you got to find a realtor that you like. That realtor's got to be able to find an assignment. A lot of assignments can't be listed on Rachel. A lot of assignments can't be listed on MLS. So you're really dependent on, you really need a good realtor that can access exclusive networks and brokers and figure that all out. Yeah. A lot of builders won't allow assignments. Although that's changing now. I find more and more builders allow it because they realize
with a fee,
albeit nominal. Yeah. So they're all those components. So from one aspect, we are different in the sense that we're completely passive.
That's a good point.
When it comes time to occupancy, you don't have to worry about getting a mortgage. You don't have to worry about land transfer.
You're just writing them a check afterwards. Yeah.
And this is important to note, especially if there's potential investors listening to this. A massive differentiator between a private equity placement and a pre-construction buy is our ability to take registered funds. So I can take RSP funds, I could take TFSA funds, LIRA, RESP to house the investment, right?
Yeah.
A builder can't accept that. So that is like a massive component, especially when you look at some of our deals having very long horizon times and people are like, well, I got to wait potentially a decade to get all my returns out. If it's locked in RSP, what's the difference really? It's locked away anyways. So that is another key component.
Huh. That's huge, though.
Huge, very, very significant.
And it's a good point. I mean, the reality is that, you're just buying into it, and that's what Greybrook's there to do, is to do all that back end.
Exactly.
So knowing that, obviously, I go to my financial advisor, who's great, I'm sure he'll be listening, and say, okay, I'm going to give you, I'm going to give you $100,000. I'm going to give it to you, and I don't need it for 5 years.
Sure.
What kind of return can you get from me? And he'll give me a big spiel about how he can't control and whatever. Same as I would tell clients about the real estate market. Sure. I don't know what's coming, who saw COVID coming, all that stuff. But is there a platform you guys stand on and say, we have delivered X, percentage of returns or on investment?
So generally speaking, the vast majority of our offerings are what we call raw land development offerings. So turning a parking lot into a high rise, turning a farm into a subdivision. On the raw land.
Sorry to all the tree lovers. Yeah.
Yeah. So on the raw land development stuff, our endeavor is to double your capital every 5 years. So if you give me $25,000 today.
You heard it here first. Double
your capital every 5 years. So that equates to an annualized average return of about 20%. So we will generally avoid taking on and I say generally, this, like, we will try.
We won't hold you to it. Don't worry.
We'll generally avoid taking on a project that doesn't have enough return profile where we can't make it super attractive to our investors. And sort of our baseline is to try to hit that 20% a year mark. And there's a lot of reasons for that. One of the main reasons is, it's an illiquid investment, right? It's you have to put your money and sort of like the guy on TV used to say, set it and forget it, right? So
it is a very set it
and forget it type of investment. So while, we take away on the liquidity side, we have to compensate on the return profile side. So we're very conscious of trying to achieve those aggressive returns. And then on the value add side, which are quicker turnarounds, and we're not developing raw land, we're just essentially rehabilitating structures, the returns get compressed a little bit in the sort of the 15 range, is where we usually land on those.
Okay, great. And this does not happen every single day. Like, someone cannot call you and say, I'm giving you $100,000 right now today. These are certain projects that open up at different times. So maybe explain to us how that works also.
So generally, we'll try to raise about 8 projects a year. We try our best to stagger when we open it up for raise. Our raise windows are very tight. So believe it or not, if I launch and we'll be launching our next raise sometime later this week, early next week. Yeah, call Rachel if you're interested. So that'll be a massive master plan community in Hamilton that we're doing, about well over 1,000 doors. So when we raise
doors are units. Sorry, if anybody who doesn't know, doors are units. So that could be a townhouse, it could be a house, it could be a condo. Sorry, go ahead.
Thank you.
No problem.
Sometimes,
I do it all the time. All the time.
So when we go for raise on that entire raise, which will, I don't want to say the number out loud, but a significant amount of money, will all be done in about 8 to 10 weeks, start to finish.
I believe that, though.
Finish.
How long can they wait for it?
Yeah.
They're losing money by owning it, right? So they need to get going.
It has to be, the deal starts and finishes in that time frame. So we'll be raising on Hamilton for the next 8 to 10 weeks, and then sometime before Hamilton finishes or right when it finishes, we'll kind of launch the next one. And so we try to stagger them. So our investors kind of know that every 6 to 8 weeks, they're going to see a new offering come out for them to review.
Okay. So there's a lot to choose from.
Yeah. So about 8 a year. Exactly.
Okay.
Yeah.
And just to kind of give perspective on what's coming. So even if they were going to buy or they're just thinking maybe I'll be that person that buys the condominium that you're, building. I think there's so much changing in the way that builders are building things. I'm sure we could have you back and talk all about legislation and how the government, even though they want you to believe they're helping you and housing to be affordable, they're not on the back end. But I think understanding how that landscape is changing. So, we know they're building smaller units, but is there a trend you're seeing, let's say, of just more green space or location or anything that you're seeing about projects that are coming up that you know of in the next 6 months?
I think transit is and will continue to be a massive driver. And even if you follow some of the sort of policy changes coming down from government, there's a huge emphasis on density around transit. So even huge. Even for what we're doing right now, for example, one of our last core offerings that we closed is Kipling and Bloor. We're going to have an offering coming out later next year, Islington and Bloor. So transit continues to be a massive component. To your point about government and making things affordable, Listen, what I can speak to is, when we erect housing, there's what we call a capital stack or a cost stack. So what component of our cost structure is labor? What component is materials? What component is soft costs, interest, bank fees? And then the last component is what we owe to the government.
Just to put a shovel in the ground.
Just to put a shovel in the ground. And I can tell you that, and what component is land, or in the high rise, cost per buildable foot. Right. I could tell you that over the years, the government component has, if we think about it as like a bar graph, that rectangle is getting a lot fatter.
I think I equated very similar to like how much it costs Canadians, let's say, to go to the pump and fill up their car with gas. Yeah. And I think that, we see, and believe me, I get all sorts of comments on YouTube, on these videos, on my social, and, greedy builders and all this stuff. Sure, yeah. And I understand the frustration of the average Canadian just saying like, I work really hard. I have a family. I want to own a home. Like I deserve to own a home. I get all that. What frustrates me, and I don't want to get off topic, is just that they don't realize it's not the builder saying, I want to make a bigger profit and I'm going to charge $1,400 a square foot. It's that the government, the city, all the different levels of government are putting on their stamp to say, and I'm taking a piece, and I'm taking a piece, and I'm taking a piece. Yeah. So now that, like, when you go to I wonder if they'll ever do this, like, when you go to the pump and they show what the percentage of tax is. Yeah. I would love for someone to do that, to show percentage-wise how much it's the same thing to build now. I was speaking to a builder friend of mine. It used to be like a 1-to-1 ratio of cost of build to labor. It's not that anymore. The labor is like 2/3 now, right? So I just think it's very interesting where it will go. Anyway, I'll leave it at that, and I'll try not to. I could spend an hour talking about it. Transit. Are you seeing changes in like the density, in the sense of like the high rise, the height of these buildings? Like I know there's a lot of talk around the Danforth, and they're changing, the density around there. And, all of these areas in the city have been low rise. They haven't had these high rises.
Yeah. I think even if you look like just up and down Bloor Street, it's also sort of mind boggling that it's like our only like true, like Yonge and Bloor being our true arteries, and so much of Bloor is essentially low rise. So
it's true. It's all low rise.
It's all low rise, right? Yeah. If you think about it. I think to the points you mentioned, more and more people are becoming kind of more comfortable or accustomed to lower units or smaller units. And one of the key components kind of we focus on is bringing down the aggregate cost to acquire. And what we mean by that is that, what's the final sticker price to the customer? So we gotta be very cognizant of affordability, and if we can deliver good housing to the customer at a price that's on par with the average or below average, that's something that we're always striving towards. So it could mean we're, compromising on a few square feet within the unit. But if we do it smartly, and the aggregate sticker price back to the customer is something that's actually affordable based on city income and everything else, then at least we're developing and providing real housing into the marketplace that people can buy, versus, just investors are looking at it, turning us into potentially San Francisco or London or New York, where so much housing is owned by investors versus end users.
For sure. And it's nice to know that Greybrook actually goes through that process and says, like, is this worth it? Because it's actually going to be something that the average Canadian can afford. Well, thank you very much for being with us.
My pleasure.
That was amazing. I feel like I learned so much. If anybody wants to reach you, where can they? We'll put it in the show notes as well. But how could they find you, Alex?
Yeah, so our website is greybrook.com. If they want to check out a little bit about the firm and see some of our iconic developments, we've just to quickly note, we've done over 100 developments since we started in 2004, and developed just over $30 billion worth of real estate. So
amazing.
Quite, our pedigree is definitely there. My personal email is alex.nisenker@greybrook.com. That's probably tough to enunciate, so I'm sure Rachel will put it in the show notes, and people can reach out to me, or they could just reach out to you, and I'm sure they know how to get a hold of you, and you can point them in my direction.
Thank you. That's amazing.
Awesome.
Thanks. Okay. Thanks.